Hello, everybody. Good morning. Welcome. I'm Paul Martino from Bullpen Capital. Thank you for joining us for our second annual post-seed event. On behalf of Venture 51 and Vader, I welcome you. And thank you for, to some extent, being interested in this topic of what the post-seed stage of investment is all about. Bambi and I started this event almost 5 years ago. This is actually the 6th year we did the event. And in the first few years of the event, we called it Venture Shift, because it was about how the venture business was changing. And now we have a more specific name because we've really seen how the seed and the Series A worlds have collided in an interesting way. Bambi.
During those years, we've had some amazing speakers on stage talking about the venture landscape and the implications for entrepreneurs and investors. We've had Chris Dixon, Peter Thiel a couple of times, Naval Ravikant, Mike Maples, Keith Rabois. But by last year, as Paul mentioned, we realized that the shift had taken place, and what was left was this big gap between the initial seed rounds and the Series A, largely because in order to land a Series A required a lot more traction than it did in the past.
Right, and so I have a slide here that we actually put together for our most recent fund deck, just to give you an idea how big the actual Series A crunch is or gap. Now these numbers are by no means set in stone, but if you're a SaaS business, a lot of times the seed investors aren't investing until you're doing $25,000, $50,000 a month, but the Series A investors are waiting for $250,000. If you're a consumer company, 500,000 downloads sounds good, but a lot of the Series A firms want 10 million MAU. So a huge gap of almost 10 to 20x in terms of the milestones required for a seed and Series A exists. And that's what the post-seed gap is all about. More and more companies are falling into this. And we don't like to even call it a gap because it really is more a discrete spot in the fundraising process as you grow your business.
Right, and now it's this stage, it's actually one of the most active stages, and most CEOs, many of whom are here, realize they actually need to go through this stage and need to raise these post-seed rounds in order to land that coveted Series A. And if you look at this data from Matamark, you can see that the so-called graduation rate has dropped significantly, and now the numbers are about 1 out of 10 seed-funded startups actually manage to close a Series A round.
Yeah, and just a couple of years ago, it was about 1 in 3. So the chances have gone from 1 in 3 to 1 in 10 over the past 5 years, a huge difference. And one of the other things that's happened is there's been a massive growth in the number of funds that actually invest at the seed stage. If you hit the next slide, our friends over at First Republic put this data together. They now estimate that there are over 300 micro VC funds focused on doing early stage investing, specifically this first round. That's up from 25 funds in 2009, so almost a 10x growth.
Right, and these new early stage fund managers, along with crowdfunding platforms that have lowered the barriers to entry into the venture financing world have really opened up this once opaque world of venture financing to the masses, and we think it's just the beginning. So there's a lot of similarities between public markets and private markets. If you think back, consider this, in 1950, less than 4% of US households owned a share in a public stock. Today, that's more than 50%. Today, less than 1% of US households own a stake in a private startup, and we think that's going to dramatically increase over the next couple of decades.
So it's an exciting time for you, the entrepreneurs, but let me put my hat on for a second. It's actually a very scary time to be a fund manager, because let me tell you what happened back in 2000. Back in 2000, there were 900 venture funds investing at the Series A, B, C stage. That number is now 90. So literally 9 out of 10 funds that existed 15 years ago are no longer in business, or they're walking dead zombies, not really making investments. Those are actually pretty steep odds, almost as tough as it is to be an entrepreneur.
Right. Well, we'll probably see a lot more of these zombie funds. I mean, the market is a bit overheated, as many of you know, but it's also cooling off right now. Look no further than Square's IPO and its market cap in the public markets, which is well below its $6 billion valuation it received in its private round. Look at Fidelity marking down its investments in Snapchat, MongoDB, Dropbox by 25 to 50%. So if we continue to see these public investors in the private markets, it makes you wonder whether we're going to see more of these these valuations priced more frequently. And if we continue to see these markdowns, I know that every investor, including the early stage investors, are going to have to think twice about paying up.
Right. And with that, I'd like to introduce our co-hosts, Brandon and Ryan from Venture 51 and Semel from Haystack. Take over, guys. I'm going to get over here.
Follow that East Coast energy. Somebody's obviously on a different time zone. But as Bambi mentioned, valuations at basically all stages of the market are really top of mind for us today. And so we have a panel called When the Music Stops, and it'll be a good discussion on what VCs are discussing with their current portfolio companies and how to prepare for a potential downturn. When designing the agenda for post-seed with Bullpen, we really wanted to have short, no bullshit panels, really kind of get to certain speaking points about things that are typically only discussed behind closed doors. So hopefully these short panels you all enjoyed today.
Yeah, and we have the really good panels, but we also have some really good keynotes. Last year, we were fortunate to have Peter Thiel on stage with us, along with Keith Rabois and Naval Ravikant and Chris Dixon. This year, we've got heavyweights John Doerr from Kleiner Perkins, Vinod Khosla from Khosla Ventures. We'll have Scott Kapoor from Andreessen Horowitz. And
Really, what was that?
Alfred Lin.
Alfred Lin from Sequoia. Thank you, Paul. The topics are going to range from talking about post-seed, obviously. We're going to be talking about what the investment themes that these particular investors are looking at across the spectrum. And obviously, I'm sure we're going to get some talk about some bubbles and gold rush as well.
Great.
Thanks, Brandon. Hopefully this is on. You can hear me. Okay. I knew that was going to happen. Anyway, so thanks all for coming. We have a really great agenda, and as Ryan was mentioning, we spent a lot of time organizing it, and hopefully that'll come out through the day. We want to thank our sponsors. Silicon Legal Strategy is back as a title sponsor, and KPMG is back as a main sponsor. As always for the Vader events, everyone would like to thank Bread and Butter Wine for providing the wine to our speakers today. A little bit of housekeeping. We got feedback last year that people wanted more space for networking in between the event, in between the panels, and more space. And so this is why we chose the venue. I think we'll really enjoy it today. Just a note in terms of like how the noise carries. If you're talking with somebody or having a conversation, either kind of step to the back or you can step outside, just to make sure to keep the noise levels a little bit lower when panelists are speaking. And we did allocate a lot of time in between the panels, so I think you'll find the agenda will be nice and mixed between content and ability to kind of walk around. And so with that, we'll kick things off.